Right. So we have about 30 pages left in this book. I think we might be able to complete it within this session if it's okay if we extend it for 5, 10, 15 minutes. Or we might have to take
Yeah, I
another
think we
session.
should. We should.
Yeah,
Almost.
yeah, yeah. Let's strive to complete this book within the session. So, just to give background to people who have joined for the first time, this book, even though you might be joining for the first time, I think there's a lot of value in attending this session and just participating in the discussion because this session is not as if I am some economics expert and I will give some insights. It's more about all of us trying to understand economics deeper. My background is in law, but I have studied Keynesian economics at university, and it's only in the last 2 years that I started understanding Bitcoin. I'm very new to Bitcoin in that sense. A few of you might be here around longer. I know Plebji told me that he came into Bitcoin 2017 and became a Bitcoin maxi in 2020. And I don't know Harsh's journey. I know everybody else I've at least interacted a few times with Athar as well now. So yeah, so I'll just quickly give context. This is actually a new section of the chapter. The part of the book that we are at is there are three parts to this book. First is economics, second is market, third is intervention. And we are at the third part. And the last session we had discussed intervention itself, what intervention means. So just on a layman friendly example to give, that intervention is something when two participants in an economy want to engage in a trade voluntarily. Intervention is third person coming in and telling them what they can and what they cannot do. So as Bitcoiners, we understand that fiat currency is already a form of coercion by a third person because you are forced to use fiat currency. It's not always voluntarily for somebody to receive and make payments and in fiat currency. And Bitcoin is literally the antithesis to that because it is peer-to-peer electronic cash. Nobody ever forces you to use Bitcoin. You are free to use Bitcoin, free to ignore Bitcoin. But yeah, so we'll start with cause and nature of artificial boom. So I'll read through the book just to give an understanding of the format. I'll read the book and I'll take pauses. And please feel free to raise your hand or just unmute yourself and speak. I'll try my best to give anecdotes and share my insights, but the point is to have a discussion between all of us. Okay. The cause and nature of the artificial boom. Imagine that the interest rate falls as above from 5 to 1%, but there is not more capital available to invest. How could that happen? If banks create new currency and offer it as loans, then the interest rates they charge will be comparatively bid down, pushing the market interest rate below where it otherwise could be. For example, 1% instead of 5%. But this is not a matter of different economic conditions. There is not more capital available, only more money in the form of loans to buy the resources that entrepreneurs need to start and finish their production projects. So the interest rate signal that entrepreneurs rely on for economic calculation is artificially low. Therefore, their decisions and actions will be based on this faulty signal. So yeah, in the last session or in the preceding part of this chapter, we had discussed that interest rates could be set artificially, and I think all of us are here aware. And if somebody's not, please feel free to ask questions. That in the current economic system, macroeconomic system, interest rate is not a free market activity. So interest rate, in a very simple definition, is like the cost of capital. It's if somebody has money as a resource and they want to lend it, and the rate at which they lend it is called the interest rate. It's the cost of capital of using that resource called money, and it is set by the central banks. It's not a free market activity at all. So currently, if two people want to engage in a loan activity, you have to, if you are a regulated entity, which you have to be if you operate at any scale, if you operate as a business, then you have to subscribe to the rules of the central bank, which is RBI in India and Federal Reserve in the US. So we discussed that it is artificially low. Whenever you see interest rates uh, being low than what the market would get it at, then you know that there's coercion here. So it could be low and it could entice entrepreneurs to take out loans to invest in projects and to have cheaper production resources available to create more value for consumers, which might sound good. It literally is called stimulating the economy, which a lot of people defend is necessary for the economy to function. But as this paragraph tries to highlight that it's not as if there's more capital available, right? Wherever there's lower interest rate, there's more money available because you're getting something at cheaper than what the market wants to give you at, what any individual is willing to offer you at. So yeah, so those decisions that come out of that lower artificial interest rate will be based on a faulty signal, right? It's not based out of voluntary cooperation or voluntary trade. Yeah, quick pause if somebody has questions or so this could be a bit in context based. So feel free to ask questions or have comments.
Isn't the market rate for borrowing costs determined by the central bank itself?
Yep, they are. I mean, yeah, if you're any regulated entity, if you're operating a business in India, you're not allowed to set interest rate how you want to. So
Because you made a distinction between individuals giving money, right, versus the state giving the money.
right, even as an individual, if you are a business, if I want to start a business and want I have 10 bitcoins and I want to start lending bitcoins to you guys, then I have to if I want to do it as a business, then I have to get registered as a financial institution, and for me to do that, I will have to subscribe to rules of RBI. I mean PMLA and all regulations related to finance. Then I have to give the Bitcoin at the rate. So Bitcoin is currently not recognized money. So this could be a bad example. Imagine I have 10 Bitcoins worth of money and I have to give the interest rate at the rate that they decide. I'm not free to give you capital on what we think is the right price.
Correct. So
Mm.
basically, all the interest rate anywhere is determined by the central government of central bank of that nation,
Yep.
right?
Yes.
Okay,
Yes.
cool. Thank you.
Yep. As above, the lower interest rate
But
means more. Hmm.
I'm sorry to cut on late. But just a small point where, I mean, my lack of understanding, my ignorance, I'll be showing that. Banks, I mean, that thing is clear, of course, that you have to give, they set a benchmark, but again, the banks can tweak it, right? As per their own, I mean, they can tweak it a bit. For example, a Kotak Bank will be offering you a different rate, or ICICI Bank may be offering you a different one. There
Right.
are some tweakings, however, that they can do. I mean, they set up a benchmark, as far as I understand.
Yes, it
Yes,
cannot
Febji,
be.
yes. Yes, yeah.
No, yeah, Faisal, go ahead.
Yeah, what you said, I mean, I was slightly engaged with something else, and that is why I could not intervene. But yes, that is how it is. So basically, people like you and me cannot directly approach the central bank and ask for a loan, right? The central bank or the Reserve Bank of India does not cater to people like you and me. Okay, they cater to banks. So it's like if the Central Bank of India, the Reserve Bank of India says that we are reducing our interest rates to 1%, it means that banks like Kotak and HDFC and ICICI can approach the Reserve Bank of India and acquire a loan at the rate of 1%. Okay. Now, if people like you and me go to ICICI or Kotak or HDFC, they'll keep their profit margins and give it to us at 2%, 3%, whatever. So when we say that the Fed has slashed the interest rate, it actually means that the Federal Reserve, or in India, the Reserve Bank of India, has slashed its interest rates for the banks, okay, because you and I do
Right,
not directly interact with the Reserve Bank,
absolutely.
okay. So that
Basically,
rate has
they
been
take.
reduced by the Reserve Bank of India, okay. So now the bank that you and I are in touch with will also behave in a subsequent manner. They will not give you at the same price at the same rate of the Reserve Bank of India. But if the Reserve Bank of India reduces the interest rate, they will also to some extent reduce, and they will also to some extent increase when needed. So their behavior will reciprocate the behavior of the central bank, but the numbers or the percentage will not be exact.
Thanks. And just to conclude, for example, if I'm a bank, I'm not an individual, I'm a bank, I take there's one rate RBI, this let's talk about RBI context over here. RBI offers to me as a bank the repo rate or whatever, right? And then I can, it's my business sense how I package it and loan it out in different manner that I have to make business sense because I'm getting the rate at which the bank announced. If they reduce the interest rate, I'm getting at a lower interest. I can borrow more money from the bank, and then how I loan it to people and receive get my profits by packaging to different instruments or different things.
Yes,
Anyway,
exactly.
and let's continue. At this rate, we will not finish the book for sure.
Right.
Yeah.
Just to touch upon one point, I think, Plebji, the benchmark is the minimum rate of interest. So you can set it, sorry, is the maximum rate of interest. You can set it lower than the rate given by the central bank, but you cannot have it higher than the central bank. So within that threshold, you can play around, you can have your business sense and build your business model, but you cannot give a loan out for an interest rate higher than that. Is my
Right. I mean,
understanding.
I've got questions, but I'll leave it for the end of it. Let's
Right.
continue. Thanks a
So
lot.
yeah, I think just to give people context, that we can take up questions after the session. So I will. I usually hang around. A few of us also do sometimes. So we can take questions that we can go deeper into after the session. What we are
I too
striving.
would suggest that, Shyam, that let's try and wrap up the book by 9 and just read. And whoever has questions can maybe make a note of it. And after 9, whoever wants to hang out can hang out and
Yeah.
discuss the questions among themselves. That's my suggestion.
Yes. Yes, makes perfect sense. Yes. Yep. Let's start from here. As above, the lower interest rates means more investments. In our example, entrepreneurs will create new airlines and expand existing airlines operation. As this industry appears more profitable, relatively speaking. As entrepreneurs with borrowed purchasing power, the new money, flow into the market and attempt to establish new production, they increase demand for capital and bid up prices. As these investments happen primarily in the capital intensive airline industry, demand increases specifically for planes, crews, and other resources used in this industry. Thus, airplanes' price tags are higher, and airline employees, pilots, and flight crews will earn higher salaries. There's a setting quick context that in the last chapter of this book, we discussed two examples, just like airline industry versus lawn service industry. So you will get more understanding as we go ahead. Their customers' increasing willingness to pay signals airplane manufacturers to ramp up their production. As the manufacturers place orders for aluminum and other materials and start hiring more engineers, their bids for those resources increase their respective prices as well. This causes a boom in investments and prices go up across the stages of production: airlines, then plane manufacturers, then aluminum producers, and then miners. Each stage sees increased demand, which means producers can charge higher prices and earn higher profits, which motivates them to further expand their operations. These conditions also motivate other entrepreneurs to invest in these industries to capture part of the profits. These increased investments are all appropriate given the signals. The prices go up, suggesting the supply was inadequate. Producers underestimated the demand. The new and expanding airlines, which are more willing and able to pay, outcompete other users of these resources. Other commercial aluminum users, such as soft drink producers, face higher prices and lower availability, which affect their profit margins. In response to the higher prices, these producers reevaluate their plans to economize on their aluminum use and consider alternatives. As a result, soft drink prices could go up, or soft drinks might start to appear in glass or plastic containers instead of aluminum cans. So yeah, you can quickly see how we have discussed in this book that economics is not one state, right? It's a process. So whenever you see investments going in one direction, you inadvertently affect other industries. So when you see greater investment and greater demand and greater prices in the airline industry, it's not just that airline industry has better demand or more resources going into it. You see other industries getting affected, which might not be intuitive on the first side. A soft drink industry might be a completely discorrelated industry from airline industry, but because both of those industries rely on aluminum use, you see that as soon as more capital investments start to go into airline industries, even the soft drink industry can get affected in magnitudes which are not very intuitive at the first sight. That the aluminium would have been available to soft drink producers is being redirected towards airplane manufacturing is not as crazy as it might seem. This is where the aluminium, according to the market's price signals, should create most value for consumers. We would expect proper market prices to shift production toward where it does most good as entrepreneurs compete to satisfy consumers, as we saw in chapter 7. But there is a problem. The higher prices in airplane production result from the artificially low interest rate brought about by banks creating new money and expanding credit, not greater availability of capital. Therefore, the whole shift in the economy toward airplane production, including all investments made to support this production, and therefore away from other lines of production that appear relatively less profitable, constitutes malinvestment. Yeah, this is not a nature of human activity, human action, or just interaction of individuals that this has happened. This has happened because of banks creating new money and expanding credit. Yep. And that constitutes malinvestment, right? Because creating new money into supply is effectively stealing purchasing power from the existing money in the supply. It's not a free market activity because nobody would voluntarily ever opt for that. Malinvestment means that investments are structurally distorted. Some areas of the economy see overinvestment, whereas others see underinvestment. The overinvestment in airlines also means overinvestment in airplane manufacturing, aluminum production, and mining, intended to meet expectations of higher demand. These investments are made to increase production capacity to meet the expected greater demand for air travel due to its greater anticipated value. As investments soar and prices go up in anticipation of the higher demand, these industries experience a boom. These industries, at least in our example, also expanded in the same manner when the interest fell due to greater availability of productive capital. The difference is that this new expansion is using resources that are not readily available, but rather are being shifted away from other industries where consumer demand remains largely unchanged. The change is therefore not a matter of the economy shifting from one line of production to another in response to expected changes in what consumers value. Instead, there is a greater demand for productive capital and labor overall as entrepreneurs establish new lines of production motivated by the artificially lower interest rate. Right. So yeah. So this activity, I hope it's self-evident that this boom in the industry of airlines is not created because suddenly humans started demanding better airlines or we have more productive capital available. It's because of the artificially low interest rate and the boom in the economy. From the bird's eye view, might seem very good, but it's artificially created. So it's not individuals acting on their own self-interest, and as a consequence, you see that as a consequence of malinvestment. From the perspective of consumer value, this boom is caused by overinvestment in response to the faulty signal in airlines and those higher stage production processes that support expanding air travel, and therefore relative underinvestment in other lines of production. Artificial booms like this, caused by the expansion of credit, can occur in longer production projects in general. Such overall malinvestments distort the economy's production apparatus. The outputs are no longer aligned with what consumers want most, as imagined by entrepreneurs. I'll just quickly give the context about entrepreneurs in this book. So you might have noticed that this book says entrepreneur, and how I have interpreted it is that it does not say businessman, right? And my understanding of this book has been that entrepreneurs are people who anticipate value creation, that they are able to see ahead of the market in a sense, that they are able to use resources to create value which the market currently does not already know of, because businessmen are already catering to the demand which is there using the resources which are there, but entrepreneurs are anticipating creation of value and how somebody is willing to pay for that. That's the reason, and that's the motivation incentive structure for entrepreneurs to take that risk. And yeah, you see how artificially low interest rates and artificial booms can completely distort that, because any anticipation of value requires somebody to take a risk inherently. And now, because of malinvestment, that risk can get distorted beyond the comprehension of a single entrepreneur, or even the entire economy for that matter, because those resources have moved from one line of production to another, and it's not always obvious how that will happen. So any intervention could have potentially many ugly effects. Yeah, just a quick pause, then I'll start with the turning point. Okay, the turning point. The boom is unsustainable because it largely consists of malinvestments, not because the economy grows rapidly. What we call the business cycle is the sequence of an unsustainable boom followed by the inevitable bust, a bubble that then bursts. This is different from the sound progression of an economy. It helps to contrast the two. First, let us look at sustainable growth. We saw above that interest rate reflects the availability of capital for productive investment. When more capital is made available, the interest rate falls, and vice versa. Specifically, this happens when consumers are less eager to buy and consume goods in the present and prefer to save a greater portion of their wealth for the future. Their time preference is lower, meaning they have longer time horizons in their valuations. They look more to the future than before. As a result, entrepreneurs that produce consumer goods face falling demand and lower profitability, and therefore have an incentive to scale down their operations and look for other opportunities. Some of them may go out of business. As a result, entrepreneurs overall reduce the production and sale of consumption goods. So yeah, it's a very intuitive first-hand experience of all of us that when you delay your consumption, you are inherently looking into the future because you want to use that good in future for more productive uses. That's the reason that you are choosing to not consume that good right now. So entrepreneurs have to do that because they are anticipating value, so they have to cut down on their profitability in the present, because that's the nature of their activity, because they have something called lower time preference. I think it's a very popular meme as such in Bitcoin. The concept originally is mentioned in the Bitcoin standard I read it 2 years ago, so I consider myself somebody who's still understanding what lower time preference exactly means. But my understanding of it is that whenever you discount the present for the future, that you are choosing to take an action which is not immediately giving you any value, or at least in the traditional sense of consumption of value, but it's giving you the potential of producing more value, and any value that is produced is supposed to be consumed either by you or someone else that you either get money from or from your loved one. So lower time preference is what allows humans to create capital goods, create better standards of living, yeah, all the good things that Bitcoin stands for. This frees up productive capital for new investments, which are now feasible and increasingly profitable, as the increased savings force the interest rate down. So entrepreneurs invest more in production processes that produce goods that will be available for sale in the future. Overall, this shifts productive capacity away from the production for present consumption to production for future consumption. Entrepreneurs are responding to price signals and abandoning production with low profitability to seek the higher expected rates of return in production for the future. This is quite in line with consumers consuming less and saving more. They are postponing consumption. In fact, the shift in production is a matter of adjusting production to where it is expected to produce greater benefit for the consumers. Right. So yeah. So the one of the thumb rules in this book has been that the consumer is what decides the price, because the consumer is the person who decides the value that they get out of any goods or service, and the entrepreneurs, without a choice, have to serve the consumers. So any decision by an entrepreneur is for the greater benefit of the consumer. So any shift in production, any use of capital, or any discount of present consumption, which is called lower time preference, is because they want to serve consumers and expect a higher profit because of consumers valuing those goods, which are not possible right now. The unsustainable boom is different. Here, entrepreneurs increase investments in production for future consumption based on the artificially lowered interest rate. In other words, there has been no corresponding shift in consumer behavior. Instead, the lower interest rate makes consumer less eager to save. They earn lower interest on their postponed consumption and thus encourages consumption in the present. This causes tension in the production structure between production that serves present consumption, which is going up, and investments that serve future consumption, which is expected to go up. I'll just read this again because I'm not sure if I'm able to completely understand this. The unsustainable boom is different. Here, entrepreneurs increase investments in production for future consumption based on the artificially lowered interest rate. In other words, there has been no corresponding shift in consumer behavior. Instead, the lower interest rate makes consumers less eager to save. They can earn lower interest on their postponed consumption. So yeah, so you understand how, and correct me if I'm wrong, that whenever the lower interest rate is lower, consumers are less incentivized to save because they are earning lower interest on their postponed consumption. Would somebody like to take a shot at explaining this? I'm not sure if I'm able to completely understand this. All right, I'll try to take a shot again. But yeah, so whenever there is lower interest rate, as a consumer, you are incentivized to save less because, yeah, I think I'm not at the best at explaining this. But if somebody has a better explanation or understanding of this, please feel free.
And I'm not, again, I mean, I will wait for the book to finish and then probably have these questions. But my full understanding is that when the interest rates are lower, and it's
Disturbance in your voice. Sorry to cut you off. There's some disturbance in your voice. If you can just check.
So, is it any better now?
Slightly, I think. I remember you adjusted
anyway,
yeah, at the beginning of the session, putting on your headphones. If you could try that again. Plebji,
Yeah, so maybe I can try. So I think
Is it any better now? Sorry.
yes, much better. Yes, much better.
So anyway, I was saying that we can leave this for the end, but my crude understanding, I'll just finish it off anyway. That is when the interest rate are low, I mean, I would be, I as a consumer, that'll trickle down to me as well. So I would be going full degen mode, and I'll be taking loans that I cannot afford to probably pay because the interest rate is so low. And thus, I would not be saving much over here. Whereas when the interest rates are high, I'm not able to borrow. I'll try to save that money. I'll have more value for that money or something like that. That's my
Right,
crude understanding of it.
right,
But
right,
let's leave it for the end of the.
right. Yeah,
Generally,
sounds.
I'll give a point. It's pretty like forward. When interest rates are down, bond markets interest sorry, when interest rates are up, bond market rates are down, right? So basically, like you are earning less if you invest in the bond market. So basically, you are less intensivized. That is number one. Number two, in a low interest rate environment, the wages also drive up, the inflation also drives up, right? So customers are less and less like they will not save because they know the value they are earning more. Number one. Number two, the महंगाई sorry, the inflation is increasing, right? Basically, so जो आज आपको मतलब whatever today you are getting for less price, it will become more expensive tomorrow. So you're less incentivized to save basically. So two big points: bond market yields and inflation.
Right, right. Makes sense. Makes sense. One question that I had was that on the Bitcoin standard, I imagine that the primary mode of savings will not be banks, right? People will just hold on to Bitcoin. So interest rates on in that world will might not be a standard interest rate, right? Like how we have currently lower interest rate environments and higher interest rate environments. So yeah, so that was how I was thinking that interest rate is not some magical number that just oversees the entire economy, right? It's the reality of today, but it's not some reality of human nature or human economy. But yeah, the bond market rate, I know that there's a clear phenomena there that lower interest rate means the bond market is down. Is it? Is it inversely correlated or directly correlated? I've never quite understood how exactly that works. But I will take this up for later. Thank you, Harsh and Plebji for
Yeah,
also
we can
pointing it
have
out.
a discussion on this. I'll provide some graphs. I'll put them in the chat after the book is done. It's very interesting. You are seeing this in America right now and
Right.
Japan.
Okay. Sounds good. Sounds good. Yeah. Thank you guys for also just pointing out that we can take this up for later. On the one hand, entrepreneurs producing for present consumption see no falling demand because consumers have not shifted away from consuming. Right. Their products' profitability is not falling, so why would they cut back their activities? Thus, these entrepreneurs continue to compete for inputs and keep placing orders for them. So, yeah, this book has been stressing about how entrepreneurs, it's not as if they are producing for future because they see falling demand. That's not the correlation. It's not as if entrepreneurs are forced to anticipate and create value in future. It's because of the expected return, higher rate of return in future. That's the incentive for entrepreneurs. At the same time, the lower interest rate causes an increase in investments for future production. The higher stages of production experience greatly increased demand as they receive orders from both the production processes serving consumers in the present and those undertaken to serve them in the future. Remember, all of this is based on the faulty signal as there is not more capital available, but there are many more buyers. The prices are bid up to very high levels. This is sometimes called an asset price bubble. So yeah, I think what I missed was the context that we are talking about an artificially low interest rate and only that environment. So in that environment, it's a faulty signal, right? And entrepreneurs are now forced to live in that environment of lower interest rate. So, like Plebji pointed out, I think it incentivizes consumers to not save in the present and have greater value in the future because you have artificially lower interest rates. So you might be incentivized to become the degen to get cheaper loans and invest in things that you wouldn't otherwise invest in. Yeah, so this creates an asset price bubble. So I'm sure all of you might have at least heard about how overvalued the current stock market and the real estate market is. And yeah, the reason is simple. The reason is the money printing that's happened in the last 4 years and overall in the last 100 years. Although competition between the new future oriented and old present oriented may seem like a good thing, the faulty signal pulls the economy in different directions. the prices of production factors are bid up as a result of the overinvestment in the higher stages of production. In our example, airplanes, aluminium mining. These price increases are based on the faulty signal and therefore detached from genuine expected future demand for air travel. These price increases include wages for workers in these stages who then have more money to spend on present consumption. With an artificially lowered interest rate, there is less incentive to postpone consumption. Therefore, a greater fraction of earned wages, which are now also higher because of the boom, is spent on consumption goods, increasing demand for goods in the present too. So I think, yeah, Saifuddin would have used this opportunity. I'm not saying that I'm some spokesperson for Saifuddin, but yeah, this is where you understand that faulty signal in economy has a direct impact on culture because people now have money to spend on which they are incentivized to spend instead of save. So it creates all change in behavior, which is artificial, not only artificial, but disincentivize people to make better decisions because immediate gratification is very easy to fall prey to, but it comes at a cost of ill health in the long run. Yeah. In sum, sustainable growth is caused and supported by a shift in consumer behavior, decreased demand for consumption in the present that makes capital available for investment in the highest stages of production. In the unsustainable boom, in contrast, there is no shift but rather added investments without additional productive capital. Thus, the production structure reflects higher demand for consumer goods in the present and the future, based on the assumption that there are sufficient capital goods available to complete all these new production projects. Another way of putting this is that the economy, through the actions of entrepreneurs who were deceived and misled by the artificially low interest rate, both consumes and invest the capital that is available. It should be obvious that this is not possible. There is not enough productive capital to support both. The unsustainable boom is thus based on production that requires resources that do not exist. Many of those production processes, especially in the higher orders, far from consumers, cannot be completed because the capital necessary is too scarce. This does not mean that factories suddenly find themselves without resources, although shortages may occur. More likely, asset prices are bid to such high levels that many investments may no longer appear profitable. Entrepreneurs then discover that they have made significant errors in their calculations and are forced to abandon their investments. So yeah, so when there is crazy money printing, you are effectively stealing purchasing power from all of the savers in the economy, and you are forcing people to you consume more than they need to, or spend in directions that they otherwise wouldn't. So it on the in the extreme scenario, it will lead into shortages because you are consuming more than you're producing as an economy. So that cannot be sustainable. But it also not only causes that, more realistically in the shorter run, it causes asset price inflation. And at one point, they become so overvalued that they cannot function as assets anymore. That they are not actually storing value, or they're not actually liquid to the point that it becomes futile to hold money in them. So I'm not sure if I'm the right person to go into the details of this, but I believe that the real estate bubble eventually leads to the point where real estate trading is the only use of real estate as a store of value. So you can flip one real estate for another real estate, but you're effectively forced to never be able to sell it because there's not enough demand, because the entire um, the entire potential market for people who will buy the real estate has dried up because there's no available enough resources for somebody to actually buy the real estate for other goods and services. Entrepreneurial error is commonplace in the market, but the errors do not usually cause boom bust cycles. What is unique to the business cycle is there is a massive cluster of simultaneous entrepreneurial errors. The reason, as we saw above, is that entrepreneurs have been misled into acting as though there were capital available for their production projects. But there is not. The expansion of credit, not availability of capital, lowered the interest rate to a level that does not reflect the real availability of capital for investment. So yeah, we discussed in one of the sessions that will we see boom bust cycles in the economy on the Bitcoin standard. So I think for the majority part, we agreed that we will see catastrophes and crises on local levels in the economy, of course, because life is uncertain. Nobody in the world can predict the future. But we will not see one phenomena for the entire economy leading us to recession, how we see in the current world, because because that requires something artificial or something so catastrophic that it affects the entire world or the entire country or the economy. But cannot affect anything more than the local jurisdiction on the Bitcoin standard, because there is no one entity that can enforce other individuals who are not part of that jurisdiction, or who are subscribing to Bitcoin, and therefore sovereign individuals. No central bank can ever affect their lives. This raises the question of why entrepreneurs allow themselves to be fooled. Do they not realize that the interest rate is artificially low? Maybe they do, but this does not matter because they still expect to benefit from the lower cost of borrowing. Why would they not pursue projects that they expect to be profitable? Even if they were familiar with business cycle theory and knew that the economy is in a bubble, the bubble is in fact highly profitable. To not expand one's business as the bubble inflates is akin to turning down profits. This may not sound like a huge problem, but the business's investors will likely feel differently. Also, competitors cannot be expected to turn down profits, so inaction could allow them to expand their market share. As a result, not expanding during the bubble is to risk one's business. So I think this is the darkest part of this book, because even as a very ethical and smart entrepreneur, you realize the bubble that we are living in and the business cycle a theory that it is artificial. The boom bust cycles are not natural consequences of human nature. You are still sort of forced to participate in the game, because if inaction leads other entrepreneurs to take up greater market share, this becomes like a that game that we played in school of people just running around chairs waiting for the music to stop, because nobody wants the music to stop, because there are not enough chairs, there are not enough resources for people to actually realize the scarcity that we live in, because there's this artificial lower interest rate that forces them to believe that there is resources that they can use to employ more people and invest in companies and just start their projects. So yeah, this is beyond just individuals being evil, because I mean, central bank, I believe, is the evil here, not individuals, because yeah, so because they are forced to act in certain ways, and they do not usually. It's very difficult for them to make ethical decisions in such an environment. There is also the issue of inflow of entrepreneurs during a bubble. As prices rise, more people see an opportunity to earn profits and a reason to leave their current employment. Thus, the boom lures those who would otherwise not enter the market as investors. The lack of experience suggests that they are more prone to make errors and thereby contribute to overall malinvestments. So it becomes a self-fulfilling prophecy of malinvestments, because yeah, you will see a inflow of entrepreneurs during a bubble, because cheap credit is very easy to fall prey to. And yep, yeah, we have about 15 minutes left, and we're about halfway through the rest of the book. So I'll quickly highlight. There are about 142 pages. 118 is where we're at. The corrective bust. The bust comes quickly. Even though the bubble itself might be easy to spot, it is difficult to predict exactly when it will burst. The actual turning point can be triggered by seemingly unrelated events that put additional strain on specific malinvestments and cause them to fail. As the production apparatus is already strained by high demand and yet firmly high prices, one failing business can easily drag down its customers and suppliers who can no longer expect to be paid for services rendered. Right. So yeah. So because the whole thing is artificial, the whole thing is musical chairs being played. It is difficult to. I mean, on one hand, it's very difficult to predict exactly when it burst. It will burst, but it will burst, right? It's inevitable reality that all of us are aware of, and it puts additional strain on malinvestments, right? Because now you see businesses failing, and even though there is higher demand, there's still high prices. There's not enough resources to be able to catch up with the prices by producers making those things, because the higher price signal is an effect of greater money into the economy. So it's not as if greater production actually solves that problem. This causes a cascade of failures that reveal the extent of the malinvestments in the economy. The mass of failing investments and therefore failing businesses and jobs lost is the bust, but note that the bust is not a separate phenomena, it is already embedded in the boom, whose investments are unsustainable. This is why we refer to the boom bust sequence as a cycle. The malinvestments that cause the boom must be undone for the economy to get back on track. It is not the case that the boom is a sound development and then the bust is avoidable. The boom is not real economic growth, but an illusion. Consumers expected something else. Entrepreneurs made investments that were not motivated by genuine value expectations, but facilitated by a corrupted signal of capital availability, the artificially low interest rate. Yeah, this is where I've been doing this for the last 3 or 4 sessions, bring in Ray Dalio's famous video on the economic cycle. I think that's what it's called. How the economic machine works is what it's called, and it goes into, it's a very graphic video, and it's very layman friendly. I mean, I think anybody who is new to economics and in general just wanted to understand what macroeconomics is and how it affects the world, I think that's a great resource. But just to point out the critical problem with that is that Ray Dalio actually defends the whole cycle. He says there's something called beautiful deleveraging, which is total horseshit, because these things are artificial and there's no beautiful deleveraging ever happening. So yeah, so these things are an illusion. These booms are illusions. These busts are the product of that artificial boom. The bust releases the capital goods malinvestment in processes that do not serve consumers so that they can be invested where they can do more good. In other words, other entrepreneurs get a chance to acquire the capital to pursue consumer value. The failures are necessary for the malinvestments to be revealed and then replaced by sound productive investments. So it's like a drug addict who defends, the central bank or the macroeconomists will defend saving the bust, saving the economy from the bust, because they will justify more money printing, more capital siphoning to the cantillionaires, because their solution to the problem of being a drug addict is that you infuse more drug. But if you let the natural nature of human economy function, then the bust will actually lead to more productive investments. So this could just be my personal opinion. A lot of people talk about how the recession or a bust in the economy affects lives, which is completely true. But that does not mean that we need some authority to intervene and protect us, because it's the exact problem. It's the exact thing that caused the problem, that some authority has power over money. For the bust to restore sound production, however, the interest rate must be allowed to increase. If it is kept artificially low, this will only prolong the corrective processes, as the new entrepreneurs will also be misled and structural errors therefore persist. One point that I think I want to just quickly highlight, I think I just want to check first where are we in the book. Yeah, so we are at the next chapter, like regulatory intervention. I'll just take a quick pause. We have about 20 pages. I'll try to cover this quickly. So just one pause if somebody has quick comments. One point that I wanted to make is that if somebody is aware of the 40-year-old economic cycle, that in 2020 we hit literally zero or very close to zero interest rates, and there's a thing called economic cycle which is 80-year-old, and we are in the higher interest rate cycle part of the cycle, and it is caused by the literal fact that you cannot have anything lower than zero interest rate. You cannot get paid for borrowing money. So yeah, so these the solution that the government and the central bank has been coming up for the last 20 years is to further lower interest rate and further print more money, and it has got to the point that they literally cannot do that anymore. So yeah, the musical chairs is about to stop. I'll begin regulatory intervention. By regulations, we mean restrictions imposed on the economy by government, prohibitions, license requirements, quality or safety standards, price controls, quotas, and subsidies, etc. Although they differ in their specifics and in their stated purposes, they are all implemented to induce a change in the economy. If regulations do not change anything, they are ineffective. This is because the specific restrictions are inapplicable or they are not enforced in practice. The point, however, is that all regulations are intended to impose some change, that they matter only if and to the extent that they do. Effective regulations, successful in producing the intended outcome or not, change behaviors and therefore the structure of the economy. Some regulations are imposed on producers, whereas others target consumer behavior. The former may impose additional costs or prohibitions on some producers or artificially lower the costs of others. The purpose is to change the types of production projects undertaken and therefore the goods made available to consumers. The latter seek to change consumer behavior, which in turn affects producers because they must respond to the changed nature and structure of the demand. In both cases, therefore, the outcome is a change in the economy's production structure. We know that the production structure is determined by entrepreneurs seeking to profit from satisfying consumer wants. Thus, for regulations to be effective, they must affect entrepreneurs' behavior and change which production projects they choose to undertake. The observable outcome, what is seen, what did not occur as a result, that the counterfactual or the unseen, and the longer term effects, the unrealized, are key to understanding the impact of regulations. Yep, regulation by its word means something trying to change, something trying to change behavior. And any attempt to change human behavior can be very easily logically derived that it could have drastic effects. But we will see three outcomes of what regulations do to the economy, which is the seen, the unseen, and the unrealized. The seen. The observable world is the obvious starting point to analyze a regulation's effects, but it can also be misleading. It is obvious because it is what we can see and measure. But studying it also leads to errors and premature conclusions because although the actual economy, its data appears to provide straightforward facts about a regulation's effect, it actually does not. So yeah, in the first chapter of this book, we had discussed and compared Austrian economics to Keynesian economics. So Keynesian economics is based on statistical data, and sometimes statistical data could be misleading because you can easily show that some project being subsidized created so many jobs, created so many industries, created so many goods and services. But because that's something you can easily see and measure, does not mean that that's the thing that the economy actually needed, or that's what individuals actually desired, or it provided value to consumers. Yeah. In a world in which a newly imposed regulation is the only change that takes place, we could easily compare the state of the economy before and after and thereby assess its effects. Yeah, so in a world in which the newly imposed regulation is the only change that takes place, he could easily. So, yeah, if we had a physics laboratory for the human economy, then you could do experiments in vacuum. You can create scenarios where only one factor is causing changes, but sadly, that's not the world we live in, and we have to bear with the difficulty of seeing that one regulation change could affect the economy in multitude of ways that we are never able to just go back in time and see what exactly is the change occurred. Right. I'll just confirm my voice is audible, right? Somebody please confirm in case
Yeah, you are audible.
I'm speaking to
Yes,
myself. Yeah. Thank you. Yeah, however, the market is a process that is in constant flux. The regulation is decidedly not the only change. It is an imposition on the market's ongoing unfolding and evolution. So yeah, the number one learning for me, just to share that quickly, is in economics that it's a process. It's a very simple word. It's a very simple realization. But I think Keynesian economics and the economics we study in school and university completely missed that point. We were never even allowed to understand that the whole economy and human life itself is a process. There's no clear answer. At least, I mean, I'm not somebody who has a clear answer. I know that there are clear answers to a lot of questions, but the economy itself, because as human progress has been a witness, there's no clear answer to what's the best use of resources. How can we create the maximum value? There's no one answer that somebody can come up with. Fundamentally, it's not as if somebody can be an expert and come up with an answer. It's fundamentally not possible because human action and human value are not some physical phenomena that you can just point at or measure. Consider the case of imposing a minimum wage, which stipulates a price floor in the market. For such a regulation to be effective, its stipulated wage must be higher than what employers already pay. If the market wage is $10 per hour, the minimum wage must require that employers pay some higher amount. It must impose a penalty on or prohibit employers from paying a wage lower than the wage stipulated. So the important word is imposing a penalty or prohibition. Any regulation is effective only to the degree that it can be enforced, right? So if there's a regulation of minimum wage that any employer has to pay a minimum wage to his employees, if they choose to not do that, there is a penalty or a prohibition on that employer for paying more than the wage that is stipulated. If the imposed minimum wage requires that employers pay $14 per hour, then that is the wage in the open market. Anything else would be illegal. Thus, before and after comparisons would make it seem like people make more money after the imposition of the minimum wage. But do they? To figure this out, we must also consider what would have been the situation had a minimum wage requirement not been imposed, the counterfactual or the unseen. So yeah, from what we can easily see and observe, minimum wage might sound like a good idea, or at least that's the argument that they come up with. That this enforces employees to protect themselves against the exploitation from employers because they are minimum getting this income. But I mean, otherwise it's illegal. But I'll just read this quickly again. Thus, before and after comparison would make it seem like people make more money after the imposition of the minimum wage. But do they? To figure this out, we must also consider what would have been the situation had a minimum wage requirement not been imposed. the counterfactual or the unseen. The unseen. Unseen refers to the other side of the story, what otherwise would have happened. Since it does not happen, we cannot measure it, yet it is the cost of any action or choice. If I choose steak for dinner, I forego all other possibilities I could have had instead. The highest value of those possibilities is the economic cost of the choice. The trade off is the value foregone. So, the highest value of those possibilities is the economic cost of the choice. So, when you have 1 rupee and you decide to spend it on one sat and you decide to spend it on something, you are foregoing all the possibilities of spending that sat. And the trade off is the value forgone. This is the cost that you pay, which is not always the seen, right? Because you see that you pay one sat, but effectively you're choosing to not spend it anywhere else. Without a counterfactual, we look only at the presumed benefit but do not consider the cost. Thus, the analysis becomes one-sided, and we risk missing something important. We also cannot determine if it was a good or bad choice. Was it worth it? We need to know the cost to answer this question. This applies also to regulations like the minimum wage in the example above. The typical purpose for a minimum wage is to raise workers' wages. Considering only the scene would make the regulation seem successful, because after the minimum wage has been imposed, there would be no one who would make less than $14 per hour. This would be a premature conclusion because we have not yet looked at the unseen. We must thus ask what would have happened had the minimum wage not been imposed. It is important to recognize that the minimum wage does not magically raise wages, but compels employers to not employ anyone for less than the stipulated wage. This is not the same thing as raising workers' wages. Let us consider an example of an employer who, before the minimum wage is imposed, has three employees. They are paid $7, $10, and $16 per hour respectively. The reason for their different wages is that their value contributions to the employer are not the same. The worker being $7 per hour is in the job training, learning the trade, which explains the low wage. Once trained and more valuable to the employee would expect to earn a higher wage in the future. The worker being paid $16 has a unique skill set that is particularly important to the employer's line of production, making their contribution greater. This worker could easily get a job elsewhere if he was paid less. The worker earning $10 has no special expertise beyond job experience and therefore makes the market wage for regular workers commensurate with his value contribution in the production process. So yeah, so anybody who wants to understand wages can quickly just see how they spend their daily lives. Whenever you spend on something, you spend on the value that you get out of the thing, right? Whether it be buying a toothbrush or the next meal, you are trying to get the most value. So whenever an employer is paying to an employee, they are paying them based on the value contribution that that employee brings to the employer. So any employer could be paying $7 to somebody who's learning the trade, but is enough valuable to be paid $7, even though it's the returns are not immediate, and still be happy with that decision. And the employee is also happy with the decision because he's getting to learn the trade and getting $7. And similarly, there could be two other employees. $10, the one with the $10 is somebody who has no special expertise, comparing to the $16 because of the higher value, very clearly evident from the higher value that they are receiving in exchange for their labor or time. And $16 has a unique skill set. That's the reason that they're getting um, paid higher than the other employees. The employer would be unwilling to pay any of these workers more than their value contribution. They are employed for contributing to the value created, not subtracting from it. Paying them anything else would be charity consumption, not production. The workers do not make less than their value contribution, either because if they did, other employers would profitably hire them at a higher wage. So yeah, if we live in a world where enough humans are able to serve other humans, and it becomes clearly simple that no market will ever have one monopoly by its nature, because there will be other entrepreneurs, other individuals trying to fill the gap of higher prices and serve more consumers at a lower cost, because that's their incentive. And yeah, so any employee that is getting paid less than what they think they deserve, they have the um, option to apply somewhere else, because in a free market there will be enough people always filling in on the gap of the demand for that service. Now suppose a $14 per hour minimum wage is imposed. This means that the employer is no longer allowed to pay anyone less than $14 per hour. The employer must decide whether to double the wage of the worker in training and raise the $10 per hour worker's wage by almost half. The third worker, who already makes $16 per hour, is not directly affected. the employer is likely to let the worker in training go because his productivity is lower than a regular worker's, but his price is now the same. We have reached the 9:05 mark. We have about 15 pages to go. I'll quickly read this. If somebody needs to drop off, apologies if I was not able to complete this. But yeah, read this. The employer cannot afford to simply raise the $10 workers wage because of his value contribution is more than $10 but less than $14. But by tweaking his production process, cutting benefits, and abolishing other perks such as afternoon coffee breaks, this worker can be kept at the higher rate of $14, at least for now. The scene, therefore, is that this employer paid an average wage of $11 per hour before the regulation was put in place and $15 per hour after, an obvious gain. The regulation worked, it magically raised workers' wages. The unseen, however, paints a different picture. If nothing had happened in the economy to change worker productivity or the profitability of the business, there would be three workers employed at a total of $33 per hour. Now there are two workers at a total of $30 per hour instead. Also, the lower paid employee is now working harder to justify his higher wage. Was the imposed regulation worth it? Economics cannot answer this question because it is a value judgment. It can identify the regulation's result and therefore show whether the regulation fulfilled its promise of raising workers' wages. It did for one worker, but it also resulted in another worker being laid off. There is more to the story because the seen and the unseen only consider effects in the present. However, as we now know, the economy is a process. The world we live in today has implications for the future too. The unrealized. Understanding that the market is a process provides further insight into the real effect of regulations on the economy beyond the seen and the unseen. To see how, we will continue the minimum wage example and work through the logic step by step with and without the regulation. After the minimum wage has been imposed, the worker in training is laid off. Rather than making some money and gaining the experience necessary to propel his career, he's now looking for a job. However, as all employers are compelled to pay $14 per hour, the threshold to get a job is much steeper than before. Without training, the workers just starting out cannot find a job where he would contribute at least that much to the bottom line. And since he also cannot get the experience that would otherwise increase his productivity, he remains unemployed. Meanwhile, the workers who retain their jobs are increasingly frustrated. The highest paid workers are unfairly treated because they did not receive a raise, while the less productive colleagues received a 40% raise for no obvious reason. And now pressure to perform is higher too, and the more skilled worker is expected to assist the less skilled worker to make production run smoothly. It was better when there were three workers, even though the third worker was still learning the trade. Now the two of them are struggling to produce what the three of them produced easily before. The skilled worker in turn believes he earned a raise and is bitter about losing some benefits he used to enjoy. He remembered when he could take a coffee break, talk to colleagues, relax, and de stress. It is more difficult to keep up now, and he feels worn out as the weekend nears. Not to mention that the worker has been told not to expect a raise for the foreseeable future because his productivity does not warrant a higher pay. This is the scene with an imposed minimum wage of $14 per hour. In the counterfactual, this is the scene with an imposed minimum wage of $14 per hour. In the counterfactual world, when there is no minimum wage, all three workers remain employed. Initially, they are paid the same as before, $7, $10, $16 per hour respectively. But as the worker in training gains experience, his productivity increases, and the employer raises his wage first to $8 and then to $10 when he's as productive as other workers on the job market. Why would the employer raise the wage? Stepped raises may have been contracted earlier. Or maybe the employer wants to pay the worker a fair wage because otherwise he would look for and get gainful employment elsewhere. The other two workers also increase their productivity and get raises. The employer can afford this because he did not have to increase one person's wage by 40%, but also because the workers and therefore contribute to the combined wealth and well-being of the company and society in general. So soon they are paid $10, $12, and $70 per hour respectively, a total of $39 per hour, an 18% increase paid for by increased production. But this is still not the whole story. The wages earned by three workers are their purchasing power, which they use to buy goods others produce. The workers' demand as a result of their contribution to supply makes revenue in other businesses possible. We can now see that the difference between the seen and the unseen, the regulations cost, is not merely the unemployed worker. This is the immediate effect, which reduces total output but increases the marginal wage and output by excluding the worker with the lowest productivity. However, what is also lost is the experience that this worker would have gained, and therefore his increased productivity over time. His future jobs and perhaps his career are lost. His increased production is also lost, and therefore the value he would have had created for consumers who will not be able to purchase those goods. Yeah, if in the last paragraphs, I think if you could not follow or take away anything, the only takeaway, in my opinion, is that in an economy where individuals are able to cooperatively decide their wages, we will eventually see a world where people can decide their skill and focus on that, so that they don't have to worry too much about getting a certain payment, because they can learn the trade at the payment that they need, or that allows them to be employed or participate in the economy, and eventually trade up because they at least have work. So the whole idea of minimum wage discludes a lot of people which could have otherwise been productive, and that's the unseen cause that affects not only their lives but also the employer's life, because they could have added value to not only the employer but the end consumer. The unrealized are all those valuable opportunities that never come to be because of regulation. The value of the goods that would have been produced, the trainees' career, the workers' demand for goods. Economy is on an overall lower value trajectory, which means the loss is all the value that would have otherwise been attained. So yeah, you also realize that the entire economy and the entire human species suffering because of such regulations. This shouldn't be surprising because free market production, albeit imperfect, is driven by entrepreneurs seeking to profit from serving consumers. When this order is upset, entrepreneurs cannot pursue what they expect will be the highest value uses of scarce resources. This means that the most productive project, including the job opportunities that they create at wages based on the expected value contribution and the highest value goods for consumers, will be lost. The unrealized is the true cost of regulation, and it far exceeds the unseen. Yeah, so because we are put on a lower value trajectory because the entire human species is suffering, then we are not able to produce the things that would have otherwise been produced, that we cannot even conceive of right now, because all the capital and all the labor and all the time that has been lost. Conclusion, action, and interaction. Yeah, we are at 12, 9, 11. I'll just quickly glide. How many pages are these? Yeah, so further reading, I think we'll not have to go over this. It's interesting that the first book for beginners is The Principle of Economics, which I haven't personally read so far myself. But yeah, we have about, yeah, nothing after this book. So yeah, I'll quickly read conclusion. I think it should take me less than 2 to 3 minutes. Then we can open up for discussion. Yeah, it's just 2 pages. Conclusion, action, and interaction. Nothing about the market economy is magic. As I have attempted to show, the market is quite real and mundane. It functions in certain and knowable way. It has a specific behavior which emerges from and arises out of people's actions and interactions. We refer to this behavior as economic laws, which are laws in the same sense as the laws of physics. There is no way to escape them, they are immutable. Critics claim markets have no nature, there are no economic laws, or they do not always apply. They sometimes claim markets are or must be designed and work in an institutional vacuum. But this is a misunderstanding. Changing circumstances will change the outcome of the market process, but markets do not function differently regardless of the institutional setting. The specific goods and services produced, the number of job opportunities, the distribution of value created, and so on are not caused only by economic laws, but they certainly are subject to those laws. All else equal, a higher price for a good means less of it will be sold than otherwise would be the case. This does not mean other influences have no effect. For example, if the government required everyone to buy some good this coming month, the quantity demanded would increase even as the goods price rose. The same would be the case if instead of an imposed requirement, a new fad made a lot of people eager to purchase that good. In neither case are economic laws being evaded or out of play. On the contrary, both outcomes are well in line with economic laws, but contingent on the specific change. Therefore, we must understand economic laws to understand the market economy and the evolution of market process. It is only through proper economic reasoning that we can uncover the economy's actual workings and make sense of the market process. If you now understand that, then I have been successful. Specific outcomes are impossible to understand, not to mention predict, unless we first understand how markets work. This means economic literacy is a necessary starting point for effective policy making. Regulations, which we discussed in Chapter 9, must take economic laws into account. If we do not understand the market economy, we cannot understand the effects regulations will have. And chances are they will not only be ineffective but destructive. Economic literacy is the antidote to destructive policy. I'll read this again. Economic literacy is the antidote to destructive policy, but it is so much more. Economic literacy is mind-opening because it allows us to truly understand how the world works. Yep. Any questions, comments? Feel free to unmute yourself.
None from my end, then I'll excuse myself. I won't be able to be a part of the discussion any further. So yeah, well done, Shyam, on completing the book, and congratulations to all those who participated.
Yep. Thank you, Faisal, for being the regular participant and being the supportive friend that you have always been.
Yeah, it's a pleasure.
Okay. Good night.